Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome to the program, everybody. Thanks for being here. I'm joined by Jeff Perry and Russ Ball. All of us are with the AMR team at Wealth Enhancement. We'd love for you to reach out with any comments or questions. You can find our show on YouTube and on our webpage, which you can find Something More with chrisboyd.com. Or you can find us wherever you like to listen to podcasts. And glad you found us today and hope you'll share and rate our program. Let's jump right in, guys. Our topic today is don't assume. And we've got a couple of things in mind, but we're going to start with don't assume you might be contributing as much as you can in your retirement plan, because at times there are catch-up contributions. You can do a little bit more. So Russ, you want to start us off talking about some of the circumstances where people should be mindful of some of these various additional amounts they can consider?
As of 2025, there's a new rule, part of Secure Act 2.0, where employees in a specific age range, and that's 60 to 63, people that are in that age range can contribute an additional amount on top of their standard catch-up contribution. A little bit confusing with all the numbers, but this year for 2025, it's going to be an additional $11,250 in what's being called the super catch-up contributions. So that leads to a total contribution limit of $34,750 for 2025, and that is going to be changing each year, most likely. But again, that's for people who turned 60 in 2025. And for ages 60, 61, 62, and 63 by the end of the year. So within that window, there's that extra contribution limit, and that can definitely help for people that are, trying to avoid some of those hefty taxes if they're in higher tax brackets, and put the money into your retirement accounts and really save for the retirement you're looking for.
So that's ideal for people who are in an employer provided plan like a 401k or a 403b or similar, large company plan, plans that are designed for larger contributions. So instead of the $7,500 extra catch-up contribution, which, just to review, in 2025, if you are an employee of any age, you can contribute $23,500 as the maximum contribution. However, if you're 50 and over, you can contribute another $7,500.
Yep.
However, so that would be around $31,000 if you were 50 and over and we're trying to do the catch-up contributions. But in these unique years, and it's funny because it's not, it's 60, 61, 62, and 63, but not 64, not 65. It's just those particular years. And it's judged by what age will you be on December 31st. If your birthday is December 31st and you turn 64, and even though most of the year you would have been eligible, unfortunately, you're not eligible. It's deemed by the age you be on December 31st. So in any case, in those circumstances, you could do, instead of the 7,500, you could do 11,250 extra. So
now
the
7,500 catch-up contribution that's been there for a while, that goes beyond the 63.
So that's right. So if that person who was 64, 65, et cetera, they could continue to use that 7,500 figure as their catch-up contribution. So it's a little bit of an oddity. I think this was from Secure Act 2.0 that we saw this and enter the details. For people who are in a simple IRA, the numbers are different. But they too have not only a catch-up contribution, but an extra one for those in that 60, 61, 62, 63 age range. And so in this instance, the base contribution you could do if your employer has a simple IRA is $16,500. And for anyone 50 and over, they can do $3,500 more. So that brings you to $20,000 for your maximum you could do when you're in that older age range, until you get into this same deal with a 60, 61, 62, 63. Yeah, it's not muddied enough, right? But in this case, now you could do instead of 3,500, you could add 5,250 to that number. Now, if you thought that wasn't confusing enough, there's one more wrinkle to make it even more confusing. Oh, good, right? So that is, let me see, what were the circumstances for this? If your employer plan has 25 or fewer employees,
okay,
instead of the $3,500 figure, you might be able to use the 3,850. There's a little bit of an extra that's able to be increased. Just an oddity. Who came up with this stuff? Congress, of course, right? Does that explain it? Enough said? Right?
Sounds like it was a negotiation, and they just said, "Let's meet in the middle and go home."
Throw you a bone. Let's be done already. Yeah. So anyway, if you need help finding out where you fit into these details, don't hesitate to reach out to us. We can help you navigate some of these things. But it is a challenging time sometimes to be clear on where do you fit. It's like that one it was driving me crazy because I was looking at someone I know who is 64 at the end of the year. And last year they didn't have the option to participate in these extras. So I was like, oh, I got to tell them, they can't do it because they're going to be 64 by the end of the year. So in any case, you got to navigate these rules a little bit more carefully. So don't assume that you don't have the ability to do more. You may have this window with different, depending on your age, you may have the window where you can contribute considerable amounts to your retirement plan, and always appealing to try to do the maximum your budget will allow or the plan will allow.
Well, we come across plenty of individuals that we talk to, clients or just folks that we come across who are in that age, like, oh, I'm 60, I don't think I saved enough for retirement. What should I do? And this is a great option to really maximize those 60, 61, 62, 63 years.
I think you guys talked about a mailbag situation where someone didn't, and thanks for doing that. That was a good episode. I enjoyed that, with the circumstance where someone was late getting started.
Right.
Well, if that's the case, I know it's never easy if you hadn't started to suddenly do a very dramatic amount.
Right.
But as I say, maximize what your budget will allow, or whatever your plan will allow. If you can do as much as that, sooner is better. It's you can't look back. You only can look ahead. So you got to do what you can, as much as you can, as soon as you can.
And these amounts do not include the match from your employer.
Good point. Yeah, that's a great point.
Yep.
So with employer plans, it can work in different ways, how much your employer matches. Sure. With a simple IRA, it's really two options. They either give a 2% or which is just a base contribution, or a 3% match. And those can vary from year to year with some disruption, but generally that's what it works out to be. And then, that sits on top of what you put in. And as we've said in the past, when there's an employer contribution, a matching contribution, you have to at least do what gets you the full match, because otherwise you're choosing to get paid less than your employer is offering you as a salary. So take advantage of it. Um, Anything else to add, do you think? I mean, there's plenty of complexities to this. And when it comes to contribution amounts, when it comes to IRAs, when it comes to other types of plans, there can be various things. But I'm inclined to think this is enough confusion for today. What do you think?
It's enough on that subject, but just one quick kind of don't assume when it comes to employer plans is
let's switch.
we see individuals come in who sadly don't know where what their investments are inside of their employer plan. Sometimes we see people who've been working for a long time and it's all in some capital preservation cash type setting.
Yeah.
And they may be young and have plenty of runway to take some risk and have the benefit of some strong gains over time. And so I guess in that category of retirement plans, don't assume that you're invested in the right place for your retirement goals just because you signed up for your 401k.
Absolutely. And what you did at the day you got hired isn't necessarily what you want it to be forever. I think a lot of times, to your point, Jeff, people just pick something when they're
Yeah.
getting started and don't really, just because they're bombarded with all kinds of benefits decisions and all
Right.
kinds of challenges. That's a good thing to review from time to time. Certainly good to get input from your advisor in the
Yes.
process. And while we're on it, don't assume your beneficiaries are current. And
Or that you have one.
sometimes, or that you have one. Sometimes plans change. Your employer made an employer plan originally, and then they switched it to another provider.
Right.
Don't assume that all your beneficiary information came over the way it should. These are things you have to really check periodically, and it's surprising how often people have the wrong, either not have, they might have an estate as their beneficiary, which kind of kills. We talked about this in a prior
We have, yeah.
episode, but it's not the ideal way to plan for your maximizing your beneficiary, structure benefits. The design of this stuff, the way it's can have longer time to take it out of the IRA, and it's just problematic. It may not go to who you want it to go to.
It may be your ex-spouse.
Yeah, and for
we've
people who've
seen
been
that.
divorced,
Yeah.
or even lived with someone, you
Right.
got to update this stuff, because sometimes who you put 10 years ago, you may just assume it was someone else, and it may not be who you want it to be.
Right.
See a number of stories like that. That Ed Slot program we were talking about in the prior conversation, Jeff. They routinely talk about these circumstances where the wrong person was not who they intended to be the recipient of the retirement plan or the IRA.
These are contracts. When you fill out these forms, these are contracts. And just because you get married or you get divorced does not per se change the contract. So
Yeah,
don't think it's automatic, because it's not.
right. Exactly. Good point. Yeah. So the old boyfriend or girlfriend may be getting instead of your spouse or whatever,
We'll
right?
see who gets the last laugh on that one.
So, well, anyway, those are a couple of good things. We've got some other things not to assume, Jeff. You had
Right.
some interesting stories more related to Social Security. Let's talk about that too.
Over the past couple months, I've had two similar client experiences which have the same don't assume. And I'll tell them as one story because they're so similar in stories. These individuals worked in Massachusetts in the public sector. One worked in law enforcement and one worked in town administration, we'll call it. And they both had long careers. One is retired, one is about to retire. And both of them told me the same thing when we were doing a review. They both said, well, I have my pension, but I don't have Social Security. And I, at first blush, knowing both of these gentlemen for decades, said that's probably right to myself. But I said, well, let's get your earnings and benefit statement from Social Security just to see. because did you work in high school? Yes. Did you work through college? Yes. Did you have a summer job? Maybe. Did you have a brief separation from public service between jobs and all these things? Did you have a small business? And so both of these gentlemen assumed that they were going to get their earnings and benefit statement, and it was going to show maybe they had, 10 or 20 quarters. And to the listeners who don't know, you need 40 quarters of qualifying income to be eligible to collect Social Security. So it's roughly 10 years, but it doesn't have to be all together.
Well,
And the income level for those given quarters is still relatively low. And back 30 years ago, it was really
so
low.
your part-time summer job
Right.
can qualify for quarters when you were a teenager, and so on, right? You maybe that craft business you had while a stay-at-home mom, or
Whatever, right?
I don't know. You know what I mean? There's all these different
Summer
things
camp
that can.
counselor, working in college, at the local coffee shop. So let me tell the end of the story.
Yeah.
So one gentleman, the first gentleman in sequence, he's 67 and he had never pulled his benefits. He pulled it and he's entitled to Social Security.
Perfect.
And so he's getting an extra $800 a month that he didn't even think was possible.
So that's meaningful bonus, little income that's coming through. I mean, $800 a month is not nothing. That's some good bills.
And he is thrilled to get it.
Yeah.
I should be
That's
on a
gonna
commission.
help.
I should have been on
Yeah.
a commission.
Yeah, you get a piece of the action.
Like in my lawyer days, a third of it or something. But
Yeah.
no, so he was very thrilled and thankful, and that's all good. The other gentleman who just got it, this is probably a week or so ago, is 2 quarters short. He's at 38 quarters. So he has a clear vision. It went from, I think I may work in when I retire, which he's planning on retiring later this year. I think I might get a part-time job to I'm getting a part-time job and I know how much I need to make.
Yeah. Yeah.
Right.
So
That's
both of these,
awesome.
under this theme this week is don't assume. Both of these gentlemen had worked decades consistently, straight through, in public service and have not been contributing to Social Security. And therefore they assumed that they did not have a benefit. And
Jeff, sorry. It's probably worth reiterating a little about the Social Security Fairness Act as part of what you're talking about. Just maybe share a little bit more about it.
Prior to this Social Security Fairness Act that passed during the Biden administration and was signed by President Biden a few months before he left office, many public employees assumed that they would not get Social Security, not because they didn't work 40 quarters, but because they were going to have a government pension. They said, I have a government pension. I heard you don't get Social Security. That was a wrong assumption because there used to be an offset. But not to go back, let's look forward. Since the Social Security Fairness Act, there is no offset any longer for public employees who have a pension that they earned. They still have access to Social Security, and now they have access to the full Social Security benefit that they received because of the private sector work that they earned over the years. So hopefully people who work in public service know that part of it, but I still think that there's many who believe that they're not eligible because they haven't worked enough. And in fact, they may have, or they may be so close, like the second example, that they just need to work part-time for months or maybe a year or two to be able to collect Social Security.
And also, there's just no harm in checking. It's very easy to set it up. It's just SSA.gov. And I had the same situation with a family member of mine, and she's like, "There's no way I qualify for Social Security. I didn't work enough. There's no way." Right. And when you log in, it shows your earnings every year for your whole life. And she's like, "Oh yeah, this one was this was this," and it turns out she is eligible for Social Security. So easy to check and definitely worth doing, because you might not remember, but there's probably some jobs you had that you're paying into Social Security.
Absolutely. And on the flip side of that, don't assume Social Security has attributed your income correctly. So for everyone who's listening, if you don't get it once a year as part of your regular routine of doing a review with your financial advisor, as Russ said, log on to Social Security, ssa.gov, create an account. You're looking for your earning and benefits statement, and you'll see how many quarters you have. You'll see your estimated benefit at 62, 66, or 67, 70, and so forth. And then the back page lists all of your income for every given year. Now, you might not remember if you earned 1,700 or 17,000 in 1982, but look at it. Does it seem right? Is there a series of zeros there that you were working? Or maybe the last few years that doesn't make sense. Maybe it wasn't attributed correctly. Just review it. It's like anything. Check your credit report. Check your net worth statement. Check your budgets. Check your Social Security statement. Don't assume that it's correct.
A good point. I think it's really important to spend some time on this. And, as much as we talk about it a lot, that opens up other decisions as well as to questioning the timing of when you decide to turn on your benefits. If you should log into the Social Security website, you do have calculators that can be a resource. There are tools. Your financial plan with your financial advisor can be a really important context to help you navigate some of these decisions. Now, much of it is determined by how long you're going to be receiving Social Security. And of course, none of us know the answer to that question. So, but if you said, well, I think health is impaired, well, that might lead you down one path.
Right.
If you say, nope, I think, I'm in good health, I hope to have longevity, that's another path. Keep in mind, it's not just about you as the recipient. If whoever is the larger income earner who would benefit from the larger Social Security benefit in a married couple, that's the benefit that continues for as long as whichever of you lives longer. So, that's another variable to, add to the complexity of these decisions. But, don't assume that, just because you might not think you're going to live as long, that you shouldn't think in terms of a delayed benefit, because it might maximize how much you get for whoever lives the longest of the two of you. Anyway, it can be complicated.
Whenever you bring this subject up, Chris, I have these visions of certain clients floating through my head that
saying, I need it now.
I was going to say, we have that too, but of clients who said, I'm not going to live that long.
Yep.
And they weren't doing it to get their Social Security early. They fundamentally believe that, whether it's family.
No man in my family has lived past 72 or whatever it is, right?
Right.
I've heard that many times. I know what you mean.
And last time we heard him say it was at his 85th birthday.
Yeah. I've had that happen many, many times where someone, in their 60s says, yeah, no way.
Right.
And then they do live into their 80s. And how long, who knows? None of us knows how long we're going to live. You're making a best guess. It's not, there's no, crystal ball on these things, but I think you're making a probability kind of thought process of, well, between the two of us, how will this play out? And I think you also have to put it in the context of everything else that's going on in your plan. Because sometimes I get it, people say, well, I really want to start this sooner because I need the cash flow. And if it doesn't have a huge impact on the financial plan, well, fine. Then, that's comforting. On the other hand, sometimes it really does have a significant impact that I've said this before, but sometimes you're better off to spend your own money sooner because you spend less of your money over a lifetime. You have more when you get that Social Security coming in later on at a larger figure. So these are things to consider. In any case, whenever we talk about Social Security, it can get complicated, but I think, what you said, Jeff, is don't assume, make an effort to get that statement. And maybe to your surprise, particularly those government employees, you may have a nice benefit coming your way, or just a little bit of part-time work before you start to dismiss that possibility, and maybe as you semi-retire or something, you
Right,
can
right.
generate a nice, healthy, income stream from Social Security that you can claim now without having to worry about offsets and all the rest of it, windfall elimination provision or any of that stuff, all gone away. So definitely talk to your financial advisor.
Mhm.
I think, the bottom line of these various topics of don't assume. Go through the process of a financial plan. Review your details of beneficiaries and taxes and Social Security
Mhm.
decisions, and so on. Take some time to go through that with your financial advisor. And if you need help in that process, don't hesitate to reach out to us. We're here to help. Um, with that in mind, you can connect with us by reaching out to our phone number is probably the easiest way, 508-771-8900. Or you can connect with us by email. And we'll give that information as we wrap up the show. And thank you for being with us. And until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.